Where are we in the markets right now? It seems like, when we see a pullback in interest rates, that's a free pass for investors to go back into the growthier names, and then it's a vicious cycle here.
Yeah, most certainly. I mean, we are really in a recession. There's no question. The first two quarters here are negative, whether the NBER calls it or not. Data was falling off really sharply in June. I'm interested in the employment report. And later today we have that service ISM report. The Fed has to be really careful. And I said that a few weeks ago, shocking people because, I was the one that's saying they were way behind and should have been tightening last year. And as they didn't, the inflationary pressures built up. And then everyone said, oh, my God, they have to tighten dramatically. And I think the market is almost over anticipating how much they're going to have to tighten. Look, all flexible prices. And that's what I mean by that. The commodity prices, housing prices, freight prices that move up and down on a daily basis, they've rolled over. Now, the inflexible prices are wages, and they're still going up. They don't respond like like the stock market or the gold market. So we're going to see those wages continue to rise. But really, the anticipation of the Fed tightening and how high they're going to have to go, I think is almost excessive now. I think the Fed has to be careful. I monitored the money supply, and, that told me that we were going to have all this inflation that we had. Well, the money supply has been brought to almost a dead stop this year, and that is unprecedented. And I said, 3 weeks ago, the Fed has just got to be careful not to slam on the brakes and just crash this economy. They've got to watch things. Yes, they have to raise, they have to ratify what's going on, but they have to realize that most of the inflation now is behind us, even though it's going to be going through the official statistics over the next 6 to 12 months.
Isn't that sort of the dynamic that you described in terms of wages remaining sticky and going higher and inflation rolling over? Isn't that a recipe for demand not necessarily to be destroyed as much as the Fed needs it to be in order to fight inflation longer term?
Well, I think that what's happened is because wages have not kept up with inflation. Really,
if inflation rolls over, then can it?
Well, what we're going to see, the sensitive, don't forget, the sensitive prices went up 20, 25, 30%. The CPI, as recorded, is up, 8%, 9%. So those prices are sort of coming down. They're still, workers have still lost a lot of purchasing power. We know about the decline in the stock market. We know the pessimism that we see in these, consumer reports. All these things are adding up to the fact is, yes, the Fed has to do some more tightening, but maybe they're going to don't have to go to that 3.25% that the funds rate is projecting. We might get a debate about whether they're going to go 75 at the end of this month if the data continues weak, and if the data gets really weak, there might be a few people there saying maybe we should do 25. And that's a shocker, I know, but I'm just saying that, my look at the dollar, look at Dominic was saying about, this is incredible. A 15% rise, that is an extremely tight market. That money is flowing in to get the high real rates that we have right over here in the United States. Real rates of interest have jumped up so much higher than the rest of the world. Hot money goes here. That's a deflationary also signal that's going on. Fed made a bad mistake, put in too much money. Can't slam on the brakes right now. Well, they're going to have to watch a lot of indicators.